The broadcast is now starting. All attendees are in listen-only mode.
Hello, I'm Carly Rogers, CAPSA's Marketing and Education Manager. Welcome to our annual Global Copper Market Outlook webinar, sponsored by ABC Metals. We are pleased to welcome our presenter, Matthew Wonnacott from the CRU Group. Matt's presentation will allow you to better plan for your business in 2016. He's a senior consultant in CRU's copper team, leading the company's work on copper demand and markets. He joined the company 3 years ago with a background in economics and China studies and has worked for CRU in both London and Beijing. Matt regularly advises major copper producers, fabricators, and financial market participants about developments in the copper industry and is responsible for CRU's copper price forecasting. He will answer your questions at the conclusion of the presentation. You can go ahead and submit your questions using the questions tab on your toolbar. If you think of something during the presentation, don't want to forget, you can go ahead and submit them, but he will answer them for you at the end. 1 hour after the presentation ends, you will receive a webinar survey. Once you have completed the survey, there will be a link to download the presentation slides. We're also recording the webinar. The webinar recording will be available on CAPSA's website and our YouTube channel. That should be up either later today or by Monday, and then I'll also email all attendees and let you know that it's out there and available. So without further ado, I'd now like to turn the presentation over to Matthew Wonnacott.
So good morning, everybody, and thanks for dialing in today. So I'm going to go ahead and talk about our outlook for the copper market in 2016 and beyond. So without further ado, I'm going to start with the first slide, which just gives a brief structure of the presentation. So first of all, I'm going to look at the current copper market and what we've seen really over the last couple of months. We've obviously seen a period of quite a lot of volatility, and I'll have a few slides on some of the reasons behind that. And then I'll progress to look at the demand outlook for 2016 and beyond, then the supply outlook, and wrap up with a look at our supply-demand balances and price outlook. So the first bit of the presentation, as I say, will be on the current copper market. We've seen the next leg down in the copper price recently. This is something that we were expecting, although it arrived a little earlier than we thought it was likely to do. There's been a lot of different factors weighing on the copper market this year, and the first slide here shows our views on what the most important factors are in terms of trends recently and in 2016. So starting with the top, global consumption has been quite weak in 2015, and we expect that to be a factor in 2016 as well. We're not expecting a strong rebound in demand growth. At CRU, we monitor the global copper market and global copper demand and speak to a lot of people in the industry, and the feedback has been consistently poor for most of the year. A lot of that has actually been emanating from the major consumer, China, but China is by no means the only area that's seen weak consumption growth. The USA has had a fairly disappointing year this year in terms of consumption growth. Northeast Asia, the Japanese and Korean mills have not been having a good year. South and Central America have seen an outright contraction in their demand this year. So we've seen probably the weakest copper market in terms of demand growth for 3 or 4 years in 2015, and we don't expect a big turnaround in 2016. Signs are not necessarily that strong going into the start of the year, and the market's in a fairly depressed mood in terms of demand. On the plus side for 2016, we've already started to see copper producers take action, and we expect further action in 2016. One of the most active producers in terms of removing supply from the market has been North American-based Freeport-McMoRan. They've come out and already closed or curtailed production at 3 US-based mines and 1 Chilean mine. We've also seen miners such as Glencore be quite active in cutting African production. So the mining companies are already taking action to try and shore up the price. It hasn't worked so far, and we would expect more to come, but I think they've, by taking action, they've at least provided some floor to the price. Also, another positive for the market in 2016 is that we're going into the year with quite low visible stock levels. So by visible stocks, I mean stocks on the global exchanges and the port stocks in China that we monitor. And they're at relatively low levels. I mean, if we talk about copper as a market relative to something like aluminium or zinc, in those markets we see a lot more stock overhang relative to consumption, sort of expressed in weeks of consumption terms, and for copper we're at relatively low levels. So if we do see an improvement in demand, at least we're starting from a better base. Other negatives weighing on the market in 2016, investor positioning has been quite short all year, and we don't really expect that to change in 2016. So we have lots of clients in the fund space, metals funds. We speak to lots of proprietary traders, and the general impression is that people want to be on the short side, they want to be shorting the market, and I don't think that's going to change in 2016. So we see that as a bit of a broad negative. The US dollar, obviously, we've just had the US Federal Reserve hike interest rates for the first time in 8 years. This is helping to keep the dollar relatively strong against all other major currencies. And because obviously copper prices are expressed in dollars globally, a strong dollar is a broad negative for the copper price and indeed other commodities. Another downward pressure we've seen on the markets lately is producer hedging. So in September, October, we had a little bit of a run-up in the price. We saw a bit of a recovery after some mine closure announcements. But at the time, we saw producers selling quite aggressively into that price rally. And you know, if producers, there are producers out there at the moment who are close to losing money, and we suspect that if we get another run-up in the price, those producers will hedge into that rally, and that could stop that rally realizing its full potential. And the final point to note is that when industries are in tough times, and we always look at cash operating costs, or you've probably heard of the cost curve as a point of support. And we look at that because it tells us how low the price can go before too much production comes offline and we see some stability. And at the moment, cash operating costs are still declining. This is largely due to oil prices, but also currency changes, mining companies renegotiating labor contracts, supply contracts, and so generally we're seeing costs falling in the industry. And that has the effect of removing price support, which is generally seen as a negative for the price when it's in the doldrums. And there at the bottom we have our expectation for the annual price in 2016. So we're looking for $2.09 a pound as an average price for 2016. So another year of average annual price declines to come, our expectation. So moving on, this slide just elaborates a little bit on the points I mentioned about producer hedging. So the chart just shows how the price developed between the period June to December. And as I mentioned, in the September and October period, where those arrows are pointing, we saw run-ups in the price and then quite a sharp halt at around the, say, $2.40 levels, somewhere around there. At the same time, we know that producers were selling into that rally, and the grey line there shows this is the report from the US Commitment of Traders report, and we can see producers selling into the rally, and that report tells us that producer shorts increased at that time. First Quantum, a major mining company, were quite active, and we can see from their Q3 report that they forward sold 170,000 tons of production at around $241 a pound. KGHM have also, another Polish mining company, have historically been quite active in hedging forward. The company has high cost production in North America, so we view there as being a chance that if we get another run up in the price, KGHM may look to increase their hedging to protect some of their high cost production in North America. And it's worth noting that around 20% of producers are underwater at today's price level, so they're losing money. So if we do see a run-up in the price, producers may take that as a chance to forward sell, lock in some margins, and at least try and protect some of their cash flow. And we see that as a big risk because it means that if we do get price rallies, they may be more short-lived than they would be if producers weren't hedging. So moving on to the next slide, just elaborating on the point about the global stock position. So this chart shows the 4 major stock series that we monitor at CRU. And it just really shows that visible stocks have been declining for a number of years, despite the decline in the price. Now, typically you would think that this would be conditions for a price rally. Obviously, we've seen a lot of things change in the global copper market, particularly expectations around China, the US dollar. Investor positioning in the market has shifted a lot over this time. But we would see this as a sort of broad positive. If consumption recovered a little bit, we could see these stocks drawn down quite quickly, and that could be what really starts a reversal in the copper price. We're not expecting that to happen next year, but it's something worth noting that if we do get a surprise to the upside, it could potentially result in a stock decline. So here's the conclusions on the first bit of the presentation. So the copper price has moved decisively downwards and falling to just above $2 a pound. It happened a little quicker than we thought it would, but the direction is as expected and as the market was looking for. The key reasons for the sell-off, I mean, there's a lot of bearish sentiment in the market. Chinese hedge funds have been quite active in the market, shorting the price, and also the US dollar has been quite strong over the last quarter, and that was also a headwind for the copper price. At the moment, the physical market, in terms of consumption, remains quite weak. We've downgraded our own growth forecast for refined copper. We've seen a lot of economists at banks and so on downgrading their forecast for global economic growth. So, I mean, and it looks as if that's going to persist into 2016. Spot premium in the market, so basically the premium you need to pay to secure physical metal over the exchange prices have been trading at very low levels all year, showing little physical buying activity, and the market has been in surplus according to our numbers. So going forward, we still expect to see the monetary divergence between the US and the rest of the world. That will keep the dollar strong, which is a broad negative for the copper price. And yeah, we expect downward pressure on the price to persist, particularly given that costs are deflating in the industry as well, so removing price support. So now I'm going to move on to look at the demand outlook. So my title for the section is Optimism for 2016 Starts to Evaporate. So, I mean, it's fair to say that throughout the year, ourselves and, in fact, a lot of analysts at banks and other consultancies have been busily downgrading their forecasts for the year to come, for 2016. And this is what we're left with at the moment. This is our demand forecast for, in terms of refined copper by country in 2016. First point to note, our expectations for global growth of 1.7%. This year, we've only seen global growth of 0.3%. So 1.7% coming off of quite a weak base year is somewhat of a muted recovery in 2016, and that's driving a lot of the pessimism we see at the moment. If we break it down regionally, we still expect Northeast Asia to have a very weak year next year, as well as South and Central America and Eastern and Central Europe. We expect contractions to continue in all of those regions. The biggest consuming market, China, we still expect to see some growth out of China, but 2.8% is obviously a lot lower than we've become accustomed to in China. China was pulling the world along for a long time in terms of refined copper consumption growth, and that's really slowed this year, and we're not expecting big things out of China next year. And for Western Europe, it's a very similar picture to this year, sort of slow and steady recovery as the Europeans sort out their economic mess, and also they've been quite active in exporting semi-fabricated products around the world. And the area we probably do expect a little better from next year would be North America. We've seen very weak consumption growth in North America this year, but next year there are reasons to be a bit more optimistic. Certainly on the housing side, the housing start data that we've seen over the last few months suggests that we're likely to see positive trends going into the early part of next year. The autos market data has continued to be quite strong. I think there is a risk posed by the strong US dollar in terms of US industrial activity and US manufacturing, but I think there are enough reasons to look for better growth in North America next year, and particularly that's going to be driven by the US market. The final market of note would be India as well. India is performing quite well recently. India is not a big commodities producer, so it hasn't been exposed to the commodity slowdown in the same way that South and Central America has, or even to some extent Southeast Asia. It's also less reliant on China than some other countries. So India is still enjoying somewhat of a boom because of the low commodity prices and its limited exposure to China. So we see better things out of India in 2016 as well. So that's our global summary. Just to focus on China for a minute, China is 45% of global refined copper consumption. So in our analysis, China really becomes the key component on the demand side. And this chart breaks down our consumption number, that 2.8%, into sectors that we think are going to perform weakly and sectors that we think have some potential. So just starting with the bars on the left-hand side, the red bars show areas where we expect demand growth to contract, and the building industry, the real estate industry in China is facing a pretty tough time at the moment. We've seen government policy started to essentially weighed on house prices a couple of years ago. The industry took a big hit and has got a lot of stock overhang. It was similar to maybe if we go back to the US 4 or 5 years ago, straight after, or 6 or 7 years ago after the financial crisis with the stock overhang. Well, we see the same thing in China. There's a big stock overhang because they've overbuilt houses, and we expect consumption in that area to continue contracting in 2016. So similarly linked to that, the air conditioner industry, demand for copper tubes and other unwinding wire in that industry likely to contract next year as well. There's a big stock overhang in consumer durables and particularly air conditioners in China, and production is being rationalized as a result. Another industry in China is struggling a little bit due to the growth slowdown that we've seen over recent years. On the more positive side, though, the government is still investing heavily in the power infrastructure in the country and other fixed asset investments, like power stations, renewable energy, schools, hospitals, railways, airports. I mean, we continue to see strong activity out of these areas as the government is looking to provide support as the economy slows down, and we expect those to provide the bulk of the growth next year. The autos market will also enjoy a better year because the government has cut taxes to encourage, to help the autos market because it was struggling for the first 8 months of this year. So that's really how our 2.8% growth rate for China breaks down, and our expectations broadly for the major consuming sectors in that country and some of the major consuming sectors in the global economy. And then this is a little bit of a longer term look out to 2019, comparing how our forecasts have moved over the last few months. And as I say, we have been on a downgrading cycle in terms of our expectations. We do expect a slow and gradual recovery out to 2019 in terms of refined copper demand growth rates, but it's a lot more muted than we had 3 months ago, and it's even more muted than we had even at the start of the year. So we've been slowly downgrading our expectations, and this will obviously weigh on the future price recovery going forward. So I'm now going to move to look at, well, just to wrap up here, So we've been doing a lot of visits to various industry events over the last quarter, listening to feedback from traders, consumers, and producers, and have been basically gradually downgrading our growth forecasts as a result of the feedback. The Chinese end-use demand is still mixed, but we expect some better numbers out of the grid and government spending next year, which should support things. In terms of the other regions, we expect weakness to persist in Northeast Asia, South and Central America. Although we trimmed our growth estimates a little bit for North America, we still see some positives, although we are a little bit concerned that the strong dollar might hurt the manufacturing sector. We basically have reduced our demand growth rate across the period. So it's a sort of slower for longer kind of outlook in terms of demand than we would have seen a year ago, let's say. So I'm now going to move on to the supply outlook. And I've titled this slide More Cutbacks on the Horizon. As I mentioned in the first section of the presentation, we've seen producers trying to take action in terms of shutting mines, shutting production in order to support the price. This has had some limited effect, but clearly not enough, because just in recent weeks we've hit multi-year lows on the copper price. So in our view, given the weak demand outlook, we think producers are going to be forced to cut more production from the market. So as a result of the cutbacks to production, we've also been revising our forecasts for mine production growth. So again, this compares to our October report, we produce a big outlook on the market every 3 months, and the blue line is basically our current outlook relative to the outlook at the last time we produced that big report. And basically, as a result of production curtailments, producers taking action to take production offline, we've seen our expected growth rates in mined copper supply slow. The chart on the right gives a view out to 2020, and although we're seeing production slow recently, we still are relying on new projects coming into the market, new supply coming online to continue the growth in mine production output. Now, of course, that's important because although demand is growing slower than we've seen in recent years, there is still growth, and we do need new projects to feed that growth. It's obviously a risk if we get too many project cancellations, and the market could swing too far the other way. And we break this down by projects that we call, we've got 4 bars there. Basically, the grey bar is production from existing operations, so mines that are already producing around the world. The red bar is production from what we would call firm greenfield projects, so essentially projects that we know are going to come online because basically the construction of the new mine has already started, it's already been financed. We're very certain that that mine's going to come online. And if you look at the other 2, these are possible and probable projects, and we would term these as risky projects, projects that look very uncertain in the current price environment. And the main point to note is that the production from the existing operations and the firm greenfield projects, so the projects that we know are going to come online, that growth is only enough to sustain us through 2018. Beyond that time, without some of these riskier projects, we're going to see supply go into reverse, basically, supply growth go into reverse. So here's a look at basically our project pipeline for the next 5 years. We take mines here with major capacities, so some of these mines you may have heard about in the news. And it's quite interesting. We can break this chart into sort of 2 parts. So the bit with the arrow, the first bit, we've called these certain projects that are likely to come online despite the price environment. And a lot of these projects were basically, they started construction and they were financed during the boom years. So when times were very good, the mining companies were plowing money into these projects, and we're almost getting the legacy of those times is going to hit the market over the next 2 or 3 years, regardless of the current price environment. And then you get mines sort of after 2018, 2019, where it's still too early for them to be under construction, and this is the area where we see a serious risk of cancellation and postponement. So people always say that mining is a cyclical business, and what you're seeing here is that cyclicality working its way through. We've ended up with too much supply in the near term. Prices are coming down, and then it's going to kill the project pipeline, and then you're going to see that cycle kick in again at some point. So I noted that producers have been cutting back, closing some existing mines due to the low price environment. And this slide just shows that in tonnage terms, with the dotted lines looking at our expectations for more. Basically, we know that some mines are already being closed, but we think, given the low price environment, we would expect to see more mines coming offline, and the dotted bars just give our estimate of what we're likely to see announced in the coming, say, 6 to 9 months. And we think it'll be somewhere in the region of 250,000 tons in 2016, and maybe 300,000 tons in 2017. So that we think that'll be needed to provide some support to the market, and we wouldn't be at all surprised to hear further cutback announcements in the coming months. So the final slide here looks at refined copper consumption. So the first bit of the supply presentation was on mined copper. Now we translate this into refined copper. And of course, we've got a couple of an extra component in refined copper production, and that's obviously the production from scrap. So some smelters do produce cathodes from copper scrap. And it's a very similar picture, because obviously the mine component makes up the biggest part. And we're looking for fairly slow rates of growth throughout the coming period. And particularly in 2016, we expect a contraction in refined copper supply growth. And then again, coming off of 2016, some fairly slow rates of growth in 2017, 18, and 19, before another contraction or another slow rate of growth in 2020. So really, although I've said that consumption is likely to grow very slowly over the next 4 to 5 years, we also see production growing very slowly as well. So it's almost, if you like, a bit of a race to the bottom in terms of supply and demand. At the moment, demand is slower than supply, and we're seeing oversupply, but at some point that's going to tip the other way, and despite the slow demand, supply will have reacted enough to provide some stability to the market. And in a few slides' time, I'm going to wrap up and show you the balances of when we think that's likely to be. So just to recap our key conclusions for supply. So we've made adjustments downwards in terms of both mine output and global refined output. This is largely due to project cancellations and producers taking offline existing mines due to the low price environment. So we've seen announcements of closures in Zambia, Chile, and North America. In North America, Freeport-McMoRan has been very active in curtailing mines. They've reduced production or shut 3 mines in North America. And that's going to lead to slower growth in the next 2 to 3 years. And that's really the main point from this slide. Also, I would say in the coming years, we don't expect a huge amount of growth coming from the scrap supply. Price volatility is really not very good for scrap merchants, and it causes them a lot of problems in terms of holding inventory, and if they're not hedged, it creates a lot of problems for them. And we see periods of price volatility often affecting the generation of scrap and the pass-through of scrap to mills. And in the coming years, I think the low price, the volatility, the difficult time that the scrap merchants have been having is likely to also affect the supply of scrap, both to the smelters and refineries, but also to the direct use mills. So I think that's also something to watch for the next, say, 2 to 3 years, is the scrap situation. So I'm going to wrap up with a final few slides on the supply-demand balance and the price outlook. And I've called this section Deflation Recycle. So I've mentioned a few times throughout the presentation that costs have been coming down. So when I'm talking about deflation, I'm talking about deflation in costs, but I'm also talking about things like deflation in oil, global low inflation. These is not essentially a very good environment for commodities prices. So the first slide we're going to have a look at is industry costs. So these are what we call cash costs of operating copper mines. Now the reason it's good to look at cash costs is, as I say, when times get tough, the industry looks at cash costs as a way to try and determine price support. In this slide, we take basically a sample of 72 large copper mines owned by public companies that report results, and we track the cash costs over time. Now, this is not the whole industry, and in fact, it is missing a portion of the more high-cost mines, but it can still give us an indication about the way that costs are moving, and we've seen industry costs coming down, and we expect that to continue into 2016. So the point being that erodes price support, and that's what investors and funds look at when trying to pick out the bottom of the market. So we can't find a bottom for the market in terms of the copper price until we see cost deflation stopping, really. And there's historical precedent for this cost deflation to run a little bit further. In the early 80s, when we had a period of low copper prices, we saw costs decline by 22%. In the 1990s, from peak to trough, we saw costs decline by 45%, and as you can see, that had an obvious effect on the copper price, and we got to a very severe situation by the end of the 90s. We had this huge run-up in costs in the 2000s, driven basically by China's massive appetite for commodities and mining companies wanting to dig every unit they possibly could out of the ground, and we're now starting to see costs come down. Now, so far, we've had a 25% reduction, or we expect that to be a 25% reduction by 2016, but we could easily see that running further as we did in the 1990s. And again, this erodes price support, and this is generally a bad thing for the price. So on this slide, this shows our supply-demand balance over a 5-year period, and with the red line being our base case price forecast. I should explain here we have 2 bars, the blue bar being the light blue bar showing the market before price-related adjustments that I talked about, and the dark blue bar showing basically our expectation for the supply-demand balance after making allowances for further price-related adjustments, price-related mine closures, basically. And essentially, the message being the market is tending to oversupply over the next few years, and also with the cost deflation, we expect to see that should be enough to push prices down in both 2016, and we actually expect that to continue running in 2017 as costs continue to fall, when we expect a bottoming out of the market at just below $2 a pound, before a bit of a recovery out towards the end of the decade, and that's really as it's not led by strong demand, but essentially it's as supply growth slows to such an extent that it tightens up the copper market, even with the weak demand. And so this is my final slide of the presentation, just summing all that up. So our global market balance has deteriorated since October as a result of the weak demand, and we expect surpluses in the period 2016 to 2018, which will weigh on the price. The copper industry and particularly the copper mining industry is focused on cost reductions, So it's no surprise that we've heard the CEOs of the big three mining companies, diversified mining companies, coming out within the last month saying they're completely focused on cost control and bringing down their costs because they see the price remaining lower for longer. And cost deflation is definitely going to be the big topic over the next 2 to 3 years. We expect funds to maintain their shorts in the market against this backdrop, and eventually this is going to push copper prices to around $2, a low of $2 a pound on average in 2017, possibly a little lower. And it's not really until 2018 that we start to expect a recovery in this market. So that was the last slide of the presentation, and I believe we've got a question and answer session now. So happy to take any questions, and thank you for listening.
Thank you, Matt. Great presentation. A lot of useful information, important stuff that Matt gave us. So if you have any questions for him, please feel free to submit those using your webinar toolbar. Otherwise, Matt also has his contact information here, and you're welcome to reach out to him with any follow-up or questions you may think of after the fact. Matt, you talked a little bit about mine closures. Can you give us a little bit more detail about that, or your view on what's happening with that?
Yeah, so far we've seen the mine closures concentrated in North America, principally because the strong dollar has not been helping the U.S. producers. They haven't benefited from currency effects, which help costs in other countries where they've had a depreciating currency. We've also seen closures in Chile and Africa. So these are the regions that are facing the most severe threats, and I would say, given today's low copper price, we would expect to see more production coming offline as producers are forced to take some action, either through the fact that they're just losing too much money and they don't have the cash flow to keep operating. But we could also see maybe some of the larger producers taking action to try and say for the greater good of the market. I think that's also a possibility.
Okay. How low do you think copper could drop based on cash costs? This person said that Glencore recently stated they could generate cash at $1.59 a pound for copper.
Yeah, I think it's quite possible that. Sorry, I'm going to work in dollars a ton, but I think it's quite possible that we see a price in the high, say, $3,000 a ton in the early portion of part of next year. We know that the Chinese always take their New Year holiday, and the market gets, in terms of demand, gets very soft in the first part of the year. The funds want to be short, so I think it's quite conceivable that we could go into the high $3,000 a ton, and that we'd need to see the price a little bit low for a time, and then that would probably prompt some more people to close, and that may give a bit of support and bring the price back up. But I think we could easily see another leg down in the price.
Okay. Well, thank you very much.
Sorry, I should state that that's on a daily basis rather than as a period average.
Got it. Well, thank you, Matt, so much for being with us. And thank you to ABC Metals for sponsoring our presentation, and all of you for joining us. I hope you all have happy holidays. And again, please reach out to Matt with any further questions or any follow-up. You will receive a survey here in about an hour. You will get copies of his slides. So certainly something you'll probably want to reference back on as you look into next year. So, and you'll also receive a recording, and I will let you know whenever that is available. Thank you, Matt. I hope you have happy holidays, and I hope everyone else has happy holidays as well. I appreciate your time, and we'll see you in the new year. Goodbye.
Okay. Thank you very much.
Thank you. Bye.
Bye-bye.